on Capitol Hill, where the CEOs of the nation's largest banks just slipped in this door behind me here to sit down for what's become an annual oversight hearing of Wall Street for the Senate Banking Committee. Front and center will be the Federal Reserve's proposed capital requirements, which bank CEOs have been vigorously lobbying against.
They're asking these questions about what Basel III endgame increased capital will do to lending, specifically lending to small businesses and low-income consumers. And it's bad, right? Because as you drive more banking out of the regulated banking system and into the non-regulated banking system that isn't required to invest in the Community Reinvestment Act, you have more of that going to predatory lenders, and lending will just become that much more expensive.
We believe the capital accumulated by the industry should continue to serve the customers in America's economy, not be subject to regulatory capture by a theoretical model. The $30 billion in excess today at Bank of America should be used to grow the U.S. economy, to support the business plan of small businesses and medium-sized businesses, to help consumers buy a home and recognize the American dream.
Mortgages and homeownership is, at the lowest it's been in terms of for younger individuals, and homeownership. The average homeowner is getting older and older and older. So it's a very important issue, and should be a very important issue for these senators because that's their constituents. Yet the proposals under the system, under the Basel III endgame proposal, are going to hurt the consumer. That's just a fact.
The rule would have predictable and harmful outcomes to the economy, markets, business of all sizes, and American households in ways the Federal Reserve has not studied, contemplated, or shared. Mortgages and small business loans will be more expensive and harder to access, particularly for low to moderate income borrowers, as costs for originating and securitizing loans rise. From beverage companies that need to manage aluminum costs to farms that need to protect against environmental risks, if the cost of hedging these risks increases, everything from a can of soda to meat products will be impacted.
Inflationary insofar as cost of capital will just be higher in terms of it'll be more expensive for many people to access credit.
Raising capital requirements by as much as 20% on an industry that all participants believe is well capitalized is a bad idea in any environment. But it becomes even more problematic with economic uncertainty ahead. The most likely result of increasing the cost of banks to offer a variety of products is that it would move more activity into the less regulated non-bank sector, which carries its own risk for consumers and the stability of the financial system.